August Biniaz joins me, and you can learn what his team is up to by going to cpicapital.com. You might remember that Ava has been on the program already, so there's going to be a little overlap as we talk about some of the projects your team is working on. But again, it's cpicapital.com. Thanks for your time here today, August.
My pleasure. Hope to add value to you and your audience.
So it's always interesting. You know, everybody has a different journey when they get into real estate investing. How did you find your way?
Ooh, yeah, great story. I mean, I've always been interested in real estate. My maternal grandfather was a real estate agent, so it was somewhat in my blood. My mom was always involved in real estate investing and owning real estate. I was figuring out, what I want to do in life in my mid to late 20s. And that's when my mom said, hey, why don't you just, get your real estate license? It's pretty simple. You get your license, people list their house with you. You put it on this thing called MLS and they sell and they give you great commission. So I went and got my real estate license, but it wasn't as simple as that. But I really didn't see myself as a broker, as an agent, but there was a parts of the business that I really loved. So early on, I started doing some fix and flips, under my license and what have you as a real estate agent, but I was much more interested in development and so on. So I started my own general contracting firm, was doing renovations, and then moved on to build more on the luxury side of single family homes, both spec and custom. Spec is when you build for yourself or your investors in the hope of selling it to the market. Custom is when you build for a particular client for their needs. So I was doing both of that. And I realized many clients that I was building for, they actually made much more money than I was making as a GC that was charging a cost plus contract of 10%. They were making sometimes in the millions in the profit. So I'm like, hey, it's better to put my time and resources on developing. And I did that for a good decade. I did pretty well in my suburb that I was in, and it's a city called Richmond, a suburb of Vancouver in the west coast of Canada. But I always wanted to scale. I always wanted to do bigger deals. And I started venturing into the world of capital raising, private equity, and I started reading a lot of books on the subject, for example, about Blackstone, books like Barbarians at the Gate and King of Capital that talked about how money was raised from institution and how private equity firms got compensated. And I wanted to merge the two worlds. And then when I researched more into it, I realized it already exists. It's called syndications. But what was different is a lot of these groups were doing multifamily real estate rather than ground up development, like what I was hoping to do in Vancouver. And when I started researching that more, I actually fell in love with the model where you could, by increasing rents, you increase the net operating income. And as long as the cap rates are not expanding, you actually force appreciate a property by millions of dollars. So I don't have the exact math, but like, for example, on a 200 unit apartment community, if you increase the rents by $200 per unit on an exit cap of 6, that's near $10 million of forced appreciation. And meanwhile, you don't have to go through rezoning, deal with contractors, having to go through different cycles. You're buying something that's stabilized from day one and is cash flowing from day one. So that was kind of the impetus for me to co-found CPI Capital with my partners, as you mentioned, one of my partners, Ava Benesaki with CPI. And initially the idea was to allow Canadian retail investors to have exposure to US multifamily, which was a very niche product. But then later on, we realized that, there was a big market within the US as well. It's like 10x the market, Americans investing in these types of alternative investments. A lot of other Canadian groups have had also hyperbolic growth by just partnering with US investors rather than Canadian investors. So now our firm caters to both Canadian and US investors, still very much focused on multifamily value add in the Sunbelt states, mainly Florida. That was a mouthful, so I hope you have some more stuff to work with there.
Yeah, that's a lot to unpack, but you're throwing out some really big numbers there. You gave an example of $10 million of forced appreciation. What are some of those things that you're doing to get that extra $200 a month per unit?
Yeah, absolutely. I mean, mainly it's the loss to lease that exists in the property. It's the potential for natural rent growth that exists in the property. It's situations where the current owner is not realizing on certain incomes they could do, like something as basic as like adding a internet package to the property. There's just so many different ways. overall is when you're looking at a property to purchase in the multifamily world, you're looking at the in-place average rents, and then you're comparing that to the market rents, to the comparable rents. You're looking at the macroeconomic factors within that market. You're looking at, hey, is there going to be certain growth here? All their rents are going to grow at that, hopefully at that 3% compounded per year. But yeah, the idea here is wherever the current in-place rents are, you're hoping to increase those rents either through natural rent growth or renovations, more efficient management, other creative ways, turning tenants and bringing new type of tenants, doing exterior renovations. There's just so many different ways to retain tenants and bring in new tenants, bring in better demographic of tenants, increasing rents and making the property perform better.
How are you finding majority of these properties? I mean, it sounds like you're finding opportunity where other people might be missing.
Yeah. So, I mean, our business model, again, we were a Canadian firm looking at U.S. real estate. So we were didn't have the infrastructure, the boots on the ground in the U.S. initially starting out. So the business model was to partner with U.S. operators initially to build a track record, to have proof of concept, to make sure our tax efficiency works cross-border, and compliance, again, overseen by both Canadian and U.S. securities commissions. So initially it was just to get some deals done and learn on the job. But eventually when we started building our own acquisition infrastructure in-house, we brought on a director of acquisition, my good friend Paul Hopkins. And when we got together and we said, hey, how do we go about this? We are somewhat market agnostic. We want to invest anywhere in the Sun Belt. We want to be opportunistic investors and see where to go. We're like, no, we have to define it. We have to find our market that we want to focus on. And since we're agnostic, what's the market that we feel the most bullish about? So we're looking at Arizona, we're looking at Texas, we're looking at Florida, Carolinas, Georgia. But we finalized our region to be Florida. So we're hyper focused on Tampa MSA, which includes St. Petersburg, Clearwater, Tampa itself, and Jacksonville. So those are our main two markets. We want to continuously invest there and continuously grow our footprint. And then if we can go from there and invest in other regions, we're more than happy to do so. But now, as far as deals and do we have a competitive advantage, over other investors, I would go back to Bo Berry's book. A good friend of ours, Bo Berry, wrote a book. He's an agent from Florida, and he talks about this concept of off-market deals is somewhat of a fairy tale. 92.7% of deals. This talks about his market in Florida, but again, it's somewhat anecdotal, but it could also be used in larger markets. But 92.5% of deals that are transacted in his market are done by real estate brokers. There's an agent involved. And the other 7.5% that are not being traded, there's somehow an agent involved. It might not be on market, but there's an agent involved in some capacity. So this idea that a lot of real estate gurus talk about off-market deals, is that possible? Yeah, there's off-market deal opportunities all the time. But when you talk about these institutional multifamily properties and the tens of millions of dollars, there's always an agent involved. And that's the key to success, the relationship with brokers. A lot of these larger institutions that the brokers deal with, they're great. They work with them. They know most probably these guys will close, but they don't have that intimate touch. They don't go out there and take them for steaks and take them, for nice dinners and smoke cigars with them and take them on boats. So that's kind of what was our angle, is go to the markets we want to be in, see who the top brokers are on CoStar, and build a tremendous relationship with them that we can be in on daily conversations with them.
Sure. Syndications is kind of aspirational for a lot of investors. And being the chief investment officer, I'd be curious as to if somebody was thinking about doing syndication for the first time, what are some of those things that they should actually be thinking of and considering?
Yeah, let's break it down. For me as a veteran real estate investor, what was it about syndication that made me fall in love with this business and dedicate my life to it for the last 5 years? Syndication is really a way to achieve infinite returns, in my opinion, for a general partner. In the world of private equity, when large institutions are buying companies either on market or off market through mergers and acquisitions or leverage buyout process, they're charging a management fee and a performance fee. So they charge a 1% management fee of the total fund per annum, and then charge a 20% performance fee relative to how well they do. They're making money literally out of thin air. Yes, they're putting their brain power, they're putting their sweat equity in the deal, but they're not themselves putting a dollar into the deal. So that's, again, what I learned about the world of real estate private equity. So syndications are very similar as well. Now, of course, it's common for the GP to put in 10% of the total equity. Some institutions, for example, Freddie Mac is requiring for the GP to put in at least 10% on a current deal that we're doing. They're requiring us to put in 10%. But overall, it can be done without injecting any money. So as long as you are good at finding the deal, that includes underwriting, acquisition, all that stuff, finding the investors, investor relations, marketing, lead gen, and asset management, which is basically executing the business plan, you have a possibility for infinite returns, because in the world of syndications, you're charging fees along the way, an acquisition fee, an asset management fee, a disposition fee, a loan guarantor fee, but you're also charging a promote or a carried interest or a portion of the back end profits that comes to the general partner. It could be as insignificant as 10%, but it could go up all the way up to, I've seen deals that are 50%, that the general partner is taking 50%. That sweet spot usually is around 30-70. So 30% goes to the general partner, 70% to the limited partners, investors, passive investors, silent partners, however you want to call it. But yeah, it's syndications is a way to be able to do larger deals with less of your capital, with you being the skipper of the boat, handling everything on yourself, having unlimited liability as a general partner. But if you're good at what you do, you're great at what you do, you put your money and reputation on the line, and you have all your investors that come with you. And if you do well, they'll reinvest with you and you can grow tremendously.
I'd have to think that dealing with Canada is hard enough, but now you're dealing with Canada in the United States, the SEC, and all of these government agencies. Is there a lot of overlap there, or what are some of the differences you've run into?
Somewhat. There's some overlap. So one of the main overlaps right away is that in states in the U.S. do also have their own securities commission, but it's mainly what the federal SEC requires. That's the guidelines you're following, even though states also do have their own rules and regulations, but you never really even hear about that. In Canada, it's the other way around. The provinces, which is our version of the states, they have much more regulations that you have to follow. Now, there's national instruments that is across the board that everybody has to follow, but provinces have their own rules and regulations. So relative to what province you're raising from, you have to do those province filings. It's similar in the US as well, but then you have to abide by their rules and regulations. So that's one layer of complexity that exists. And then there's also a lot of verbiage that is similar but have totally different meanings. For example, in the US, you hear a lot about offering memorandum. Offering memorandum is usually the marketing package that the real estate agent puts together to market a property. In Canada, an offering memorandum is an exemption that we could use to raise capital, similar to your 506C or 506B Reg D offerings. So there's issues there with these miscommunications at times, or 1031 exchange. A lot of people believe that you could buy a property in Canada and you could defer your taxes. That's not the case. Not only that, the CRA, Canada Revenue Agency, doesn't even recognize 1031 exchanges. So if you opt to do a 1031 exchange to appease the IRS, Canada doesn't acknowledge that and will tax you on your gains. Compliance side, there's, again, accredited investor, for example. You talk about somebody being an accredited investor. Are they an accredited investor in Canada? Or are they an accredited investor in the US? Is it both? Just to break that down a bit, an accredited investor in the US is someone who makes $200,000 a year individually, or $300,000 a year with their spouse, is somebody who has $1 million of net worth, net of any mortgages. That's it, blanket. So they could have a $2 million property. Well, they could have a $2 million investment property. And if they have $1 million mortgage, that $1 million is equity. That makes them an accredited investor. In Canada, it's very similar. It says someone that makes, an individual who makes $200,000 a year, and with their spouse who makes $300,000 a year. But that's in Canadian dollars, not USD. So there's miscommunication there right away. There's some level of opaqueness. And then you have the net worth requirements. In Canada, they say someone who has over $1 million of financial assets. So this is stocks, bonds, somewhat liquid investments. So that's one way also in Canada you can become an accredited. But then the total net worth is $5 million, which doesn't exclude your primary resident in Canada. So if you have a $10 million property, personal resident, and you have a $5 million mortgage on this property, that $5 million of equity, even though be it your primary resident, will automatically make you an accredited investor in Canada. So the confusion is probably the most difficult part when it comes to compliance. So groups like us have to be compliant on both sides of the border, but taxation is the really rough one. And I'm happy for you to ask that question and answer anything about tax.
Yeah, well, you have opened that door. So before we jump into that, head over to cpicapital.com to learn more about what August and his team are up to, and maybe it's something you can participate in. It's cpicapital.com. And if you found some value in what we're talking about so far, do us a quick favor and share this with one of your investor friends. And if you're watching us on YouTube, give us a quick like and subscribe. So, August, why don't you broach the subject on the taxes? I mean, you must have a team dealing with this between Canada and the United States.
So we have multiple teams, and the journey has been blood, sweat, and tears to figure out how the taxation works across border. And the most difficult part was, again, these experts, these people who advertise themselves as cross-border tax experts, and these CPAs who think they know it all, both in Canada and the US, which majority of them don't know anything about cross-border taxation. It was everybody had their own opinion, everybody had their own idea of how these things work. And we finally, after having conversations with multiple different firms, we finally connected with an advisor who's a tax attorney in the US, but works for a Canadian accounting institution. So it was a perfect mix after a couple of years of researching, and rather than them just giving their opinion over the phone, which what we were doing with many others, we asked them to draft a tax memorandum. So most people are not even aware of this. You ask for a tax opinion, you write it down, your accountant tells you about it, and you go and implement it. You get in trouble. You say, hey, my accountant told me this 2 years ago, and it's out in the clouds. But when you ask for a memorandum, the accountant or the tax lawyer actually has to draft it, have to put their logo on it, put their signature on it, have to state the pieces of the Tax Act, be it Canada, the US. So they're putting their stamp and signature like an engineer would do on your plans if you're building something similar to that. And then you can use that as a guide for yourself, for your investors, for your bookkeeper, for institutional investors possibly want to work with you, with your lender. So that's what we did. We used a tax memo. And when we went and saw our advisor, we told him about all the pain points that we had. One of those pain points was our Canadian investors are required to file U.S. taxes. And this is something we followed with many other large Canadian firms. We're like, hey, they do this. We might as well follow them. They've done so well. They've done over $5 billion of transaction. They must know it. They must know the best way. Let's just follow this and do that. That was the biggest pushback from Canadian investors. Like, we already deal with a CRA. They're already rapacious. Now we got to go deal with rapacious and litigious. So now we have to go deal with IRS as well. So that was a big pain point, having to file. And then there was also cost of filing every year, which resulted in erosion of their returns because they're paying between $500 and $1,000 in tax return costs, which then what it results in, any cash flow that they're making is going to pay just cost of filing taxes. So then what happened is we said, hey, listen, the structure we want our investors not to have to file U.S. taxes. So that was one of the requirements that we had. We want to be able to work with both Canadian and U.S. investors. We want them to be totally separate, separate entities. And there's depreciation on the U.S. side. Canada's depreciation is not as accelerated as the U.S. depreciation. You can't depreciate things. It used to be 100% front load depreciation or bonus depreciation through cost segregation. We only have 4% a year here in Canada. So how do you figure that out both sides of the border? So a lot of complexities that came along the way, but we learned on the job. We stuck to our guns. We said what we wanted from our tax advisors, and now we have a streamlined process. Our investors invest with us. They don't have to file U.S. taxes. Our entity, our partnership files on their behalf. They receive their T5013 slip, which notes what they have, the taxes that have been paid on their behalf in the U.S., both federal and state, and then they give that to the Canadian tax agencies, and they acknowledge that, and they pay the difference between that amount they've already paid to the Americans to CRA relative to their income that year. So
a lot of things to keep and manage. And I'm going to change the subject slightly on you on the next question, because marketing is a big aspect of this, where you're trying to attract those professionals that might be looking for more of a passive route when it comes to investing in real estate investing. In doing so, you have to really establish your reputation and present yourself as that thought leader. How have you accomplished that? Because you and Ava have done a fantastic job in that front.
Yeah, no, I really appreciate this question, and I can put a lot of time on this. But initially, when we got together as partners, and this was kind of the foundation of why we decided to go this direction and spend so much time and resources and energy on marketing and brand building, even though I have zero experience in marketing, background in marketing, I never even took a weekend course in marketing, but I understood the importance of it. And so initially, when we first started CPI Capital, in my experience as a builder, as a developer, I always had deals. There was always deals. The issue was always equity. The issue was always nobody knew me to come in and invest with me or partner with me. So my advice to my team was, rather than starting and building the acquisition infrastructure, the asset management infrastructure, let's start building the marketing and lead gen infrastructure, initially around us as the leadership team, around the company itself, and then other team members who join along the way. Let's focus there. Let's focus there and bring in leads. Let's nurture those leads. So then when we go out there and build our acquisition infrastructure, that there is at least some investors we could go to be able to bring, close these deals. So that's what we did. We put a lot of time and resources around building a brand, around myself, around Ava, around other partners. We got very active on LinkedIn, very active on letting every news media know about what CPI is doing, with Ava being our CEO, a female CEO in a space that less than 3% of the CEOs and top executive team are females. So that brought some awareness to the company. We were featured in Yahoo Finance, and we were featured in Forbes. And these are not the paid subscriptions you see some people do. And when you research it further, is an account out of India. This is actual Yahoo Finance and actual Forbes, which is not an intermediary that does it for a paid cost. So we were able to get ourselves noticed, amongst also speaking on many podcast platforms, a lot of conferences. So a lot of brand and it was built around us. So if you do something simple as Googling Canadians investing in US multifamily, myself, Ava, other team members, and CPI will be on the first page right on top of everything. So that was achieved. We achieved that. We achieved the marketing. We brought in, I think at the time before we started focusing really on acquisitions, we already had over 5,000 investors in our database. We also needed a way to nurture these leads. So a monthly email was good. But what I noticed is there's so much content being created on the commercial real estate space, and nobody was all out there summarizing this and putting it in biteable pieces and sending it in a simple email on a weekly basis. That's what we did. We created a weekly email that goes out to our investors, which summarizes all the information, all the reports, all the articles that have been written about commercial real estate every week. And we upload that. We send that to them every week. We also add our podcast to that email, add everything else that we want them to know. And now they have this summarized weekly update about what's happening in the world in their inbox. So that's how we nurtured these leads. And we learned a lot of stuff on the job as well. There was a lot of initiatives that we initially started doing that were not paying off. There was others that were paying off. So we started flowing the attention and resources into things that were working. But these days with social media, with the internet, if there isn't a brand built around you, and a lot of people are very some people I know, they don't want to have social media. They're very reserved and what have you. But if you want to be in the space of raising capital and you just don't have a few people you can call, or you're not like a Blackstone of the world where Steve Schwarzman left the bank he was working with and he was doing M&As and he just called up a few funds and they jumped on board, and on their first fund they raised over $1 billion. If you don't have that, the first thing you got to do is you got to build a brand around yourself and leverage anything you have. If you have a good voice, get out there and make a lot of audible content. If you have a great face, make a lot of video information. If you enjoy doing research and then give it to your audience. Do leverage whatever you have to be able to build a brand around yourself and some credibility. So at least you look taken seriously before somebody comes and signs a 200-page document and transfer you, $50,000 or $100,000.
Well, you let the secret out of the bag. That's why I started with a podcast. The YouTube channel came second. I don't have a face for TV.
No, I get the
So
joke. It took a little minute there.
it took a second, but that's okay. One of those things that you mentioned earlier is that I'm going to cut this section out because I lost my train of thought. I started laughing and then I forgot what I was going to ask you.
All good. Totally fine.
So, the team building regarding all of this is also quite interesting. I mean, based on, you said, until you had boots on the ground in the United States, that you were able to maybe accomplish some of this a little further. Like what type of process did you go through in order to make sure you had the right boots on the ground and that you're building the proper team? Because this would have had to take a lot of planning and a lot of focus.
Absolutely. Again, the brand building, the marketing side comes in to serve you when you are looking for team members or potential co-GPs or other people to partner with, service providers, brokers. They always look, people Google you right away. If you Google yourself and you don't show up on the first page, it's your own name. If you don't show up on the first page, there's a problem, right? So I have somewhat of a unique name, August Biniaz, so I'm always on the first page, but there's just so much information there. So that marketing side, brand building, content creation really served us to be able to partner with other groups. The first deal we ever did was a $92 million deal, over a $30 million equity raise. CPI had never done a deal before. How did this other group, this other sponsor that we partnered with, how did they trust us enough to bring us as a co-GP on a $92 million deal? It was that brand. It was the fact that our faces were everywhere. We were looked at this Canadian group who's bringing Canadians to the U.S. So there was a mystic side to it as well. They were excited to see what this group is up to. So again, it's all about being clever, and being smart is different than being clever, right? Being smart falls under the book smart category. Being clever is about problem solving and being sharp. So you have to have a little bit of both. So I think on the marketing side and building a brand really helps with that clever side of the business, which then allows you to make partnerships. Same thing happened with other team members. We have some tremendous team members. Like I said, Paul Hopkins, our director of acquisition, the guy is an engineer. He's built billion-dollar bridges in the past. Just a great mind. We're so excited to have him on our team. Our other partner, Seth Ferguson, again, another great mind. He's built the largest conference, not just real estate conference. Largest real estate conference, not a multifamily conference, but a largest real estate conference in Canada. Every year it gets 3,000 seats filled in Toronto. And he's built that, and he's one of our partners on CPI Capital as well. So the brand that was built, the track record that we were able to amass, very quickly, how the fact that everybody knew us. I was on a ski lift with a good friend of mine, James. If he watches this, he'll remember this. But we were on a ski lift going up. There was a couple of guys beside us, and I was chatting to him about, what we were planning to fund. We were planning to launch a fund, and the guy beside me turned around and said, "Oh, excuse me, are you August by any chance? August Biniaz?" I'm like, "Yeah, how you doing?" And he's like, "Hey, yeah, I know who you are." And we started chatting, and James was totally surprised that even on a ski lift, this guy that runs a fund management platform knew about August Biniaz just because August was talking about the fund. So marketing goes a long way, and it also builds trust around your friends, family, business associates who want to associate with you and want to, build with you, invest with you, and come and partner with you as well.
Yeah, when it comes to this type of marketing, whether it's the podcast, YouTube channel, and everything else that you have going on, it's really counterintuitive, and people are almost repulsed by having to do that, but it's getting comfortable with the uncomfortable and actually doing some of this, because it's just an investment like anything else.
Less than 5% of LinkedIn users post regularly. Jump on LinkedIn, get noticed, post. This is, if you feel, too embarrassed, it's not going to come across that you're too, you're uncomfortable. It's going to come across as you might be unscrupulous. Is this person purposefully being opaque? Is this person staying in the shadows because they're afraid of something about their past? Get out there, be confident, talk about what is it that you do, and get some coaches or take some supplements or something, and get out there and get noticed. I know it's hard for a lot of people. It's hard for my partner Ava. She's an introvert. She always says that. I never understood it. But it's, it's easier for some of us and harder for others. But that's the recipe to success. And it expedite the process. It's not that You cannot be successful or wealthy or do well in your business without marketing. You could. It's just the process is much more grueling and much longer.
So what is CPI Capital's current project? What's top of mind right now? What are you currently working on?
After 24 months of deals not penciling out, after 24 months of being cautious and looking at interest rates, not knowing where they're going to be going up or what's going to happen, we feel confident that the Fed is finally going to, probably reduce rates this year. The spread that the lenders are giving to us over the 10-year Treasury has subsided. Now, currently on this current deal that we have under contract, we're getting 150 basis points above the 10-year Treasury, which brings it to still a sub 6% interest rate. Our going in cap is almost 7%. So we're in a positive leverage situation right off the bat. But after 24 months of deals not penciling out, we finally have a deal under contract. Very excited about it. It's a deal in St. Petersburg. It's a 506c offering. So allows you to publicly, market it. So that's why I feel, I'm liberal in my conversations about it. But yeah, it's a multifamily value add deal in Tampa, St. Petersburg, which is a submarket of Tampa, suburb of Tampa. And yeah, the closing is coming. And now we're in late May. Closing is coming in early July. So we're raising for that deal. We've completed our due diligence. So our deposit has gone hard. As they call it in the US, our earnest money has gone hard. So now it's time to finalize and raise all the capital and close on this deal.
If you're interested in this deal or anything else going on, head over to cpicapital.com for more information. August, this has been a wealth of information. I really appreciate you providing your time here today. Before we transitioned into what I call the rapid fire questions, is there a question or concept you wish we would have covered here so far?
No, I'm just going to quickly talk about this concept that I've looked at recently, is this idea of deals penciling out. Earlier, I just said over the last 2 years, deals were not penciling out. So what does that mean? Penciling out in what way? In real estate, as long as you can make money, deals should pencil out, So if the interest rates go up and, the yields are coming down, as long as you can get a better price on a deal, as long as you're making that profit, you should be able to still do deals. Why aren't deals penciling out? So that always come down to the targeted yield. What is the return an investment firm or an investor is looking at? And that number changes. If you can take your money and invest and put it in 10-year Treasury, which is the closest to guarantee you can get in an investment world, the word guarantee is automatically associated with fraud. It should never be used. But the closest thing you have to guarantee is a 10-year is a Treasury bond, is a U.S. government backed by U.S. government. So on a 10-year Treasury, if you can invest in that, or if you can, put your money there, and you're getting 8%. Currently, it's at 5%. But if you're getting 8%. Why would you come and invest in something riskier at 10%, 15%? That asymmetric return has to be there. If the 10-year Treasury is giving you 8% and you want to invest in an alternative like a multifamily syndication, if syndication has got to give you at least 20%, right? So that strike point changes relative to where the economy is and where there are other low risk options returns you're achieving. So when the 10-year Treasuries were when the Treasuries were, between 6 and 8%, the deals were getting our investors around 15%. It didn't make sense. That's why the deals were not penciling out. So I just want to touch on that concept, because a lot of time it gets missed. So the target for us as an investment firm is around between 15 and 20% average annualized returns. But that depends on where other extremely low risk investments are yielding. So investors should always look at that, because inflation is high. Inflation is at 9%. Every year you're losing 9% of your money on just to inflation alone. So whatever you're investing in should yield you much higher than that. So there's a lot of these basics in economic concept that you need to understand before just investing and looking at just some numbers and seeing what the returns are.
No, I really appreciate you giving that additional insight. I mean, especially regarding inflation, because I don't actually think most of us have taken the time and actually considered that piece of it. We see it every day when we go to the grocery store, but when it comes to our investment portfolio, it might become a secondary thought.
Yes. And real estate always moves faster than inflation. So if your money is in real estate, you're protecting yourself against inflation.
Well, August, again, it's cpicapital.com to learn a little bit more about what the team is up to. But if you're ready, I'll throw a few rapid fire questions at you.
Absolutely. And we have both sides. So cpicapital.ca, that's on the screen, or .com. Both of them can reach us.
Yeah. I'm sorry if I said the wrong thing there.
No, you didn't. Shoot.
Okay. Well, first of all, what lie do real estate investors tell themselves and sometimes to others?
Ooh, what lie? What lie? Instead of, rather than calling it lie, I say attention and focus. I think a lot of focus goes on to the great things the deal has. A lot of times we get hyper focused on a deal we're working on and so excited, and there's so many moving parts that we're not putting any attention focus on things that might be wrong with the deal or reasons we should walk away from the deal. A great friend of mine, Dugan Kelly, who's also our attorney, told me once, the best real estate deal you've ever done sometimes is a deal you walked away from. So it's more about attention and focus. Maybe all their focus shouldn't be on trying to get something closed. It should be also reasons why you should walk away.
Do you have a book recommendation, or what are you reading right now?
Book recommendation. Let me see. Does it have to be real estate, or can it be anything?
Anything.
A book that was really, I wouldn't call it life-changing, but it opened up a lot of points is Sapien.
Okay. Yeah, I do know that. I actually have that in my Audible library.
Okay. Yes, nice.
Yeah, I haven't listened to that one yet. If you could go back in time and give your younger self one piece of advice, what would that be?
Focus. The shiny object syndrome, what it does, it just, in business, in other things in life, focus is the greatest achievement. And honestly, I don't mean any insult by this, but what separates us and animals and other creatures is the fact that we are able to have such immense amount of focus. But when we lose it, we're underperforming.
What single strategy, process, or tool have you implemented that has had the biggest time-saving impact to you or your business?
It's got to be software. For example, CRM, we use HubSpot. Task management, we use Asana. And ChatGPT, we use it on a daily basis.
Well, August, this has been a fantastic conversation. I appreciate you giving me so much time. Again, it's cpicapital.ca. I really appreciate it. And I hope you'll come back again and we'll visit and dive a little deeper. I'd love to spend some time with you just talking about mindset maybe sometime.
Absolutely. My pleasure. Thank you for having me.